What's up, everyone? So today I want to give my top 4 dividend stocks for 2018. And generally, dividend-paying stocks do not appreciate quite as much as, say, growth stocks that do not give out a dividend. But two of these that I am giving today do have the potential to for the share price to appreciate as well. So yeah, I mean, as I said, generally, dividend-paying stocks are generally a more safer investment, maybe for older people that just want to kind of protect their money, maybe get that annual dividends. But there are a couple of these that, like I said, they do have the chance to appreciate. Two of these are in the oil sector, and if you haven't already watched some of my previous videos, I am pretty bullish on oil, so those have the opportunity to appreciate with oil prices. And the other two are REITs. And if you don't know what a REIT is, it's a real estate investment trust. So basically a company invests its assets into real estate, and what they get from rents and things like that, they pay out in a dividend. So the first stock that I like is AMLP, and it's not actually a stock. This is a MLP index fund, and they invest in oil and gas MLPs, and they pay a 7.5% dividend. And that is pretty high. I think the average in the United States dividend yield is around 3%. So 7.5% is very, very attractive. And this does, like I said, have the opportunity to appreciate with oil. Right now it's around $62 a barrel. If oil goes back up to $100 a barrel, I believe this was trading around, I think around $20 per share back when oil was $100 a barrel. Right now I believe it's around $11 to $12 a share. And another thing that you have to watch out for whenever you invest in index funds or REITs, there's usually an expense ratio associated with those funds, and basically that is what you pay for whoever is managing that fund and selecting individual stocks for that fund. That's basically what you pay to have that managed. And this one does have a pretty high expense ratio of 1.42%. Typically they're around 0.5%, and those can really eat into your profits. So 1.42%, that is a pretty high ratio. And I mean, you're getting a 7.5% yield, but reduce that by 1.5%, so you're getting about a 6% yield at the end of the day. That's still pretty good, still a lot better than 3% that you normally get for the average stock. The next one is Schlumberger, and this is an individual stock that's in the oil and gas sector. This one I talked about in my previous video, so if you haven't watched that, go ahead and watch the previous video. But basically this is an oil and gas servicing company, so they don't rely as much on oil prices, but they do pay a 3% dividend yield. And with this one, since it's individual stock, you don't have to pay an expense ratio. So obviously you're not getting as big of a dividend, but you don't have to pay anything to have it managed. And this one as well, it's been beaten up pretty badly. So this one as well has a lot of room for growth, not just dividend-wise, but the share has a lot of room to appreciate. And the next two are REITs. The first one is VNQ, and that is a U.S. investment trust. So like I said, REIT is real estate investment trust. So basically a company goes out and buys properties, whether it be commercial, usually commercial, sometimes can be residential property. And what they collect from the rents, they pay out in the form of a dividend. And this one pays out a 6.5% dividend yield. And this one has a very, very low expense ratio of 0.12%. That's probably one of the lowest that you're going to find. And this one, as you can see the 1-year chart, it has really done nothing the last year. Usually REITs are a much safer investment. They're not really going to go up too much, and if the economy, if we go into a recession basically, they're also not going to fall too much. So this is definitely a safer investment. And the last one is DRW, and this is a non-US REIT. So basically they invest in anything that's not in the US. And this one has actually gone up quite a bit in the last year. So I mean, I say Usually REITs don't go up that much. The actual share doesn't appreciate that much, but this one has, probably due to, emerging markets always have the opportunity to outperform a lot quicker than the U.S. So I mean, not only has this one, gone up quite a bit, it also pays an 8.5% dividend yield, which is really good. Their expense ratio is 0.58%, so at the end of the day, you're getting about an 8% yield. Combine that with how quickly it's gone up. But with dividend paying stocks and funds, I would recommend, these are generally a longer term hold. It makes sense if you're going to hold it for longer than a year. This is not something that you just want to trade in and out of. This is something that you're going to be in for the long haul. And if you do buy this, I would recommend reinvesting those dividends. Usually most brokerages have the option to reinvest dividends for free. I know TD Ameritrade, every single stock that offers a dividend, fee-free, you can reinvest those. That's just an option that they provide on their website. And that's where it becomes really interesting when you start reinvesting those dividends and just start building a bigger position. That's where it becomes really exponential, when you start taking what you get in dividends, putting it back in stock, and then with that stock that you bought with the dividend, you get dividends from that. So that's where it really becomes exponential. And for the long haul, this is a very good option. Now, as far as risk goes, obviously the first two, they will fluctuate with oil prices. The last two are REITs, so generally real estate is a more stable investment. Back in '08, obviously we had the housing crisis back then. I do not see that happening in the future for as long as I can see. I see real estate really starting to maybe cool off a little bit. It has been pretty hot in the last couple of years, but I see it. I do not see another '08. We really have too low of supply, and demand has been pretty heavy as well. So I don't see another '08 happening anytime soon. So that is definitely a more stable investment. Obviously, the non-US REIT, that's going to be a little bit riskier of an investment, just because it is outside of the US. But you are compensated for that with the better dividend yield, and also the shares have a better chance of outperforming the US, but it can also be a little bit more volatile as well. So yeah, let's go ahead and go into my computer. I'm going to show you the charts of these stocks, kind of look at the history. I know AMLP has a pretty recent fund, actually. It just started, I think, back in 2013. But we'll kind of look at the 1-year charts and the longer term charts. Okay, this is AMLP, and this is the oil-based ETF, basically the MLP. I'm going to try to go through these pretty quickly. I'll show you guys first 1-year chart of all these, and then go through and do the 5 years. So yeah, AMLP, this pays I believe 8.5% dividend yield, but it does have a very high expense ratio of 1.42%. So as you can see, it bottomed around $10 per share, and it has rallied recent with oil. This isn't going to rally quite as much with oil prices, just because they do pay such the high dividend yield. Usually those don't fluctuate quite as much. But as you can see, as oil has gone to $62 a barrel, it's rallied from 10 all the way up to about 11.5 per share. And let's go ahead and go to the 5-year chart. Okay, so yeah, back when oil was around $100 a barrel, this was a $20 stock, bottomed all the way down to $7 per share back when oil tanked down to $28 per barrel. And right now it's just been hanging out kind of in the $10 to $12 range. Has gone into overbought a little bit recently, but really almost every stock, along with S&P 500, the broader markets, and oil as well, has gone into overbought territory a little bit, just because it's rallied so much. This doesn't necessarily mean that we're going to see a sell-off, but it does mean that we'll probably see it either stabilize. Usually it doesn't remain in this elevated part for too long. Usually, at least, it either sells off or it does stabilize. I also want to mention with MLPs, there is a little bit of a risk and concern with the actual business model of the MLPs provide. There's a little bit of a doubt, like I said, just as a whole with the business model. They do operate a little bit differently. I'm not totally aware of how their business models operate. So, I mean, I just want to make you guys aware of that. I mean, this might be a little bit riskier than, your average oil-based ETF or company, but I mean, that's what MLPs are notorious for, is paying very good dividend yield. So I mean, you're getting compensated for, a little bit more risk. And let's go to Schlumberger. So yeah, 5-year charts. This is back when it was, oil was $100 a barrel. And yeah, it kind of sold off with, as I said in my previous video, they've had some issues with Venezuela. They have assets in Venezuela, and that's why it kind of sold off so much. Go to the 1-year chart. So yeah, sold off quite a bit and rallied recently with oil as well. This is the one that pays the 3% yield, and they have no expense ratio because this is an individual stock. And we can go ahead and go to VNQ. And as you can see, this has done pretty much nothing for the last year. Just kind of stays in this range. And that's kind of typical of a lot of REITs. If we can go to a 5-year setup, you can see a little bit longer range. It does appreciate very slowly. Back 5 years ago, this was 65 bottom, and right now it's around 80 to 85. So yeah, you're not going to see much growth from the share itself. This is definitely a much more stable investment. This is just something that's going to give you a very good yield, and it's relatively safe. And we're going to go ahead and go to the last REIT, go to the 1-year chart. And this is the non-US REIT. And as you can see, this is one that pays 8.5% yield, and it's really gone up quite a bit in last year. So, I mean, if you do select the right funds and REITs, you do have that potential for share growth and dividend yield. And when you have both those things, that can be a really powerful thing when you're getting an 8% yield and it appreciates the way it did in last year. Now, I mean, if we go to a 5-year, it's not always just up and up and up. So yeah, as you can see, 5 years, kind of all over the place. It looks like it bottoms around 22 in 2015, and really it stayed in this range of about 25 to 32 for the last 5 years. So, I mean, I guess even this one is pretty range bound. You're not going to see a ton of appreciation. It might be a little bit more volatile than a US, the VNQ, which is US real estate, just because this is international. But you do get a little bit more opportunity for it to outperform as well. Okay, yeah, that's it for this video, guys. I just wanted to go over, obviously, younger people don't generally invest in dividends, but I do think it is a great option for younger investors because they have longer time frame to just reinvest those dividends, and that's where it becomes really exponential. So yeah, I just wanted to go over my top picks for dividend-paying stocks and ETFs for 2018. So yeah, that's it for this video, guys. If you made it this far through the video, go ahead and comment on what you think of my picks for 2018. Subscribe if you haven't, and thanks for watching.